Corporate Finance Practice Problem using Excel. Common stock price calculation assuming no growth and standard dividends. Get ready, it's time to take your chance with Corporate Finance. Here we are in our Excel worksheet. If you have access to the Excel worksheet and would like to follow along, note that we are in the Practice tab as opposed to the Example tab. The Example tab in essence being an answer key. We have the information on the left-hand side. We will use that to populate the blue area on the right-hand side. Now taking a look at the common stock valuation of the common stock. Common stock can be a little bit more complex because we could have different objectives with the common stock that we might have in some other type of investment scenarios. For example, we might be investing in types of stock that are basically somewhat stable, not really growing, but at a point where they're paying a constant dividend, in which case we would have a kind of a similar scenario as our starting points for some other types of investments to think about our rate of return in those situations, which would be a little bit more straightforward. And then, of course, if we have situations where the company is growing, we have to take into consideration the growth and that kind of stuff as well with our calculation of the common stock. So first, let's start to think about a stock, which is going to be the more, stable type of situation where we have a company possibly that is already established type of company. They're not really growing at this point in time, but they have stable, basically, returns on it, and they give a solid dividend. And therefore, the reason for investing in that type of company possibly is to have that return on the investment, the actual dividend. So we're going to start there. We're going to say that the annual cash dividend is $10.20. And the plan is to keep this dividend for some time into the future. That's usually kind of an indication that you're talking about a type of company that has been, somewhat established type of company. They're not really, seeking massive growth, rapid growth like a startup type of company, but they are maintaining their earnings, and therefore they're going to be maintaining a standard dividend. If you have a company that's in a growth kind of situation, typically companies like to basically increase the dividends. Companies don't typically like to decrease the dividends. So small growth companies might be putting the money back in to the company, might have smaller dividends. And then once the dividends are going out, typically they have kind of a standard idea of increasing the dividends as basically a signal that the company is doing well and whatnot. Decreasing the dividends is less something that you wouldn't want to do as much, at least from a signal standpoint, usually with the company. So we're saying here, standard dividend, no real plan to increase the dividend, stable growth. Required rate of return for the common stockholder is going to be the 18%. If that were the case, what would we consider the price to be for the stock? So if we're going to say, all right, the annual dividend is going to be the 10.2, and then we're going to say the rate of return is going to be that 18%, making that a percent, going to the numbers, percentifying it, font and underline. Then I'm going to take this is going to be equal to 1020 times divided by the 18%. That's going to give us the 56.67. So we're looking price 56.67. Why? Well, of course, because if we take then that 56.67 and we multiply that times our rate of return, we're going to make this into a decimal. Our rate of return is going to be the 18 and multiply that out. Let's go ahead and make that a percent and then underline, font and underline, and this is going to be equal to the 56.67 times that 18%. That would give us the 10, adding a couple decimals, the 1020. That would be our standard rate of return. So obviously in this scenario, we're thinking about the return that we're getting basically solely being the dividends as our rate of return, making it fairly easy and somewhat similar to calculate our rate of return as some other kind of more standard types of investments. Gets a little bit more complex if we're looking into companies that are having growth and signaling that growth possibly with increased dividends over time.